and welcome to this, the third episode of the podcast, Reimagining Pensions, the podcast where we talk to movers and shakers in the pensions industry about what they're doing to reimagine pensions. As always, I'm joined by my partner in crime, Charlotte Moore.
Hi, great to be here. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. We are delighted to welcome to the third episode of the show, Claire Southern, partner at Hogan Lovells. Welcome to the show, Claire.
Thank you, and huge thanks for having me here, and a big thanks to Paul for describing me as a mover and shaker.
You are certainly a mover and shaker, Claire. You are certainly a mover and shaker. Well, let's get into some of that on this podcast. And to complete the lineup, for those that don't know me, I'm Paul Kitson, partner and head of pensions consulting here at EY. So, Claire, on the first couple of podcasts, we've spoken a lot about surplus, kind of what that's doing in the industry, how that's kind of changing things. We've had two trustees on the first two podcasts. It's great to get a legal view and someone working in that field. So perhaps maybe to start us off, it'd be great to hear some of your reflections, some of what you're hearing as you kind of work with clients and others in the industry at the moment on this surplus question.
Yeah, so you've probably had people on before that have been able to talk in exciting terms about the opportunities, and now you've got a lawyer in to completely dampen it down and ruin the excitement in the room. So I think it's really fair to say that there has been a big shift in the environment with all of these discussions around surplus. And the thing that I'm most interested in is what that means for trusteeship and fiduciary duties. And it's really easy to be excited about what we could do. But I guess the bigger question is maybe like, what should we do? And some of this takes us into uncomfortable places, particularly for lawyers. But I guess we should keep some perspective in this because these are good problems to have, like not knowing what to do with too much money is an amazing place to be for the stakeholders sitting around the table.
Yeah.
I think the shift that I see is really around the nature of the trustee role and this like sort of nebulous mantra of acting in members' best interests. And I think when you grew up as a pensions lawyer many moons ago, as I did, you had a really clear sort of concept of what members' best interests were. And, you know, I can sort of recall having sort of union reps in trustee meetings who were trustees who would be put very firmly back in their box at the suggestion that they should dare to argue for an improved benefit for members. You know, that is not the job of a trustee. That is the job of a union rep, and you've got your wrong hat on in the room. And I think that what we're seeing with this sort of surplus piece is a potential shift away from that commonly understood background that, you know, pension trustees' duties are around only securing accrued rights. And what we're now seeing is some trustees positioning themselves as an advocate for benefit improvements on the basis that's in members' best interests.
And is that, I mean, obviously one of our podcasts dealt with Stagecoach. Is that on your mind as you say that, Claire?
Yeah. So I think that's that's just a super interesting case, right? And I would love to have been a fly on the wall for some of those discussions because I can't imagine that the end place was where everybody actually started out. And, you know, when we look on it, members obviously have, they've secured a benefit improvement. They're sitting there with what I'm sure is a super strong covenant. But maybe there's a contrast to be drawn with the Boots case, which was, you know, not that long ago either, where basically the trustees had agreed to stop people being able to take an unreduced early retirement benefit. And they did that to allow there to be a buy-in solution for the scheme. So I guess really with this, the context very much depends on how we judge this. And if we play it forward, if we have some sort of terrible 1 in 100 event, which seems to happen like about every 3 weeks, as far as I can see in pensions,
and in UK generally,
yeah, I mean, like, you know, you've rolled from a financial crisis to Brexit to COVID to an oil crisis. I'm like, what? You know, it's not a black swan, really, is it? If we play it forward and we have one of these 1 in 100 events, and you know, pension schemes are terribly hit by it, businesses are distressed, like maybe there's one set of trustees that sit there looking really smug, and maybe there's another set of trustees that feel a bit, did we do the right thing? But at the same time, if it doesn't play out like that, maybe there are some fairly annoyed members of pension schemes that feel that they could have had higher benefits, and one that feel that they really pulled off something of a coup. So I think context is really important. And I guess one of the problems of being a lawyer is that in all elements, including in your personal life, you're basically trained to be negative. You sit there going like, what could go wrong? And my job is basically to protect people from what happens if it all goes horribly wrong. So that's sort of like what we're designed to think about. And I think that's why probably that Stagecoach transaction raised quite a lot of sort of eyebrows around lawyers in particular, saying that is very much a stepping outside of the conventional role that we would see a trustee taking part in.
I just wonder as well, with this, with a surplus rather than deficit, I wonder if it sort of like fundamentally changes a trustee's attitude towards endgame. Because as you said, your role as a lawyer is to think about everything negative, but a surplus is suddenly, you know, sweetness and light and fluffy bunny rabbits, and we've got money to spend. And I wonder if that means that you're no longer thinking about, I have to go to buyout, even if the regulation is pushing you that way. Are you thinking more about run on, and are you looking for different end game solutions to run on? Not necessarily just running the scheme on, but thinking about whether you can have run on as part of a consolidated solution. Does that fundamentally change the attitude?
Yeah, look, I think there's been a huge shift in what has happened, and part of that is economic, like the economics of all of this have shifted, so we have these surpluses. But there's also just been a really big political shift. And I think if we sort of rolled back 5 years, I don't think many people would have said, other than perhaps some like really big financial institutions where their day jobs are investing money, I don't think many organisations would have said, we want to run this thing on forever and generate surplus out of it. But I also think at the same time, if we rolled back 5 years ago, the idea that we would have a government saying, you only need to fund your scheme to a low dependency basis and you can extract surplus on top of that. I just don't, I mean, that certainly wouldn't have been in like where I would have thought the world would have gone. But very quickly, those things now feel mainstream. And I think your comparison to deficit is really interesting because, of course, we've always had situations where trustees have had to manage situations, have difficult conversations with employers. But the difference there was that a recovery plan and a deficit plan, how you're going to get rid of this problem, was also always subject to the scrutiny of the pensions regulator. And to be honest, this feels very different. This really feels like it's a conversation to be had between sponsoring employers and trustees without that sort of eye of the regulator needing to sign off on whatever solution you end up. So it does feel like quite a shift and quite a different job for trustees to do. Now, there's a whole wealth of like 1,000 years of trust law, which hopefully embraces our trustees as they try and make these decisions. But I do think that the model around trusteeship is potentially stretched by what we're seeing.
That's really interesting. And obviously at the same time as that and all of those conundrums for trustees, we're seeing, you know, consultation on the role of trustees and those sorts of things. So how Claire, in your sort of role as a legal advisor to exactly those groups and to corporates, you know, dealing with them on the other side, I mean, how does one navigate all of those things? What's your thoughts on that trustee area?
Yeah, so I think the role of trusteeship is hard in the context of surplus. And I mean, I just want to make clear that I think that professional trusteeship has been a huge benefit to our industry. When I started in the industry, professional trusteeship most definitely wasn't the norm, even on really big schemes. It was seen as very much a sort of either a gold standard or something that you had to do if your business was in real distress and you needed a sort of an independent force on the board. And I think the rise and the normalising of professional trusteeship has raised the standards of trusteeship, not only for schemes that have professional trustees, but for all schemes. It's really sort of set the benchmark here. And even our lay trustees, I think now, are in a completely different space to where they were 20 years ago.
I think definitely getting some, I can say this as an old man now with grey hair starting, getting some youth into that as well. I mean, it used to be the place that actuaries and lawyers went to die, but it's, you know, it's good that it's a very different different model. So no, I agree, it definitely helps. But sorry, I put you off your stride. Please continue.
But I think one of the vulnerabilities of that model is if there are big chunks of money on the table in terms of surplus refunds, and corporates have the power to remove and appoint trustees, there has to be some sense of a risk around corporate sort of shopping for the most friendly trustee who's going to basically agree to something. And one of the difficulties around trustee decision making is there are concepts around a trustee decision can't be irrational or perverse. But other than that, the sort of limits around it are sort of endless. You know, as long as you could find one other person that would have said, yes, as a trustee, I would have done the same thing, there's nothing that really can be done about your decision making. So I can certainly see that there's a vulnerability there where corporates might decide that they're going to, RFP a scheme and basically look to sign somebody up who's going to do the most aggressive thing as far as surplus return as can possibly be fitted within the legislation. So I suppose I'm quite interested around what independent trustees are going to do to protect themselves and members from that type of influence, recognising that they're sort of commercial entities like we are. I mean, everyone has a mortgage and kids to pay for. So, it raises a tension, though, I think, in the model.
And I just wanted to sort of maybe move away from the trusteeship and think more. You mentioned there that we have these 1 in 200 year events every 3 weeks. So it's less a black swan and more a white swan with very heavy black mascara swimming across our screens every now and then. So how do we and all of these negative events actually sort of like reinforce the sort of the inflationary and the high interest rate environment rather than push us back down to a low interest rate environment. But that could happen too. So how do we make sure that we stay flexible around that? Because we don't want to put all our, to use another foul analogy, we don't want to put all of our eggs in one basket and then find out that actually we're going to move to a low interest rate environment. Maybe we're not forever in pink fluffy clouds and surplus and we might slip back into deficit again. How do we keep that flexibility, and what role do the trustees really have and the lawyers in keeping that flexibility?
So I think you're spot on, Charlotte. I mean, amazing capacity to forget seems to linger in all human beings. And I think I must have sat for 20 years in trustee meetings, listening to employers struggling and saying they can't pay off the deficit and they need a recovery plan of 25 years before they could possibly get close to paying it off. And people used to sort of laugh at the idea of contribution holidays and going, can you ever imagine such a thing happening again? And yes, you're spot on. Something shifts and we can be straight back there. For example, we could have an oil crisis, for example, and boom, everything suddenly changes. One of the things that I find fascinating is when that conversation surfaces, people say, oh, yes, but schemes are so much better hedged than they used to be, Claire. So, even if you haven't got an insurance solution, we've hedged those risks. We've covered off the interest rate risk, the inflation risks. And then I think to myself, well, it's fascinating that you say that, because since the Liz Truss government, I sit in trustee meetings all the time and we get liquidity reports now, and we talk about collateral recalls and how much liquidity we need should we have a change in interest rates and what that would do. And before the Liz Truss government, I never heard that word mentioned once. And I feel part of the problem is, how do we know what we need to be alert to? It's often only when something hits us that we can actually say, oh God, of course, that's completely obvious. We should be doing something about that. So I think that question around flexibility fundamentally links to how skilled we think we are at being able to spot what will come next and what the implications are of that. And I just think that's really tough. I think what trustees can do is be really challenging of this stuff and sort of, almost throw in the weird left field idea that no one's thought about, and make your advisors go away and think about the stuff that probably sitting in their little box they aren't thinking about. And it sounds like complete madness until something happens like, oh, you have a referendum on whether we want to stay in the EU and actually most people don't want to. And you go, didn't actually, for some bizarre reason, we didn't see that coming.
Yeah. I mean, sorry, go Paul.
Well, I was just going to say, I think you're spot on with that assessment. And one of the challenges, as you quite rightly say, with the kind of actuaries and investment advisors keep getting pulled up on the why do we have a 1 in 200 event every third week, is that it's premised on a whole bunch of assumptions. So one is, you're right, risks that perhaps we haven't really thought about or how manifest aren't allowed for. And then the other thing is all of these numbers are premised on the fact that things won't all happen at once. And as we know from the financial crisis and many other things, actually when things really go south, everything kind of correlates and sort of comes to comes together. So that's part of the challenge. And then so you articulate that really well. I guess the other thing I'm interested in from your perspective on the legal side, working with some very big funds, some smaller funds, and maybe back a little bit to something like Stagecoach, which is that a one-off? Are we going to see more of those? Is how, I suppose, innovative should trustees be to this sort of flexibility question? Is it okay if lots of funds choose to deal with their surplus in very different ways, interact with asset managers in different ways, do different types of insurance? I mean, there's already a smorgasbord of different sorts of buy-ins you can do, a with profit one, deferred, so on and so forth. Is that okay? Or do you think there should be more industry kind of coming together as to these are the ways we think that pension funds generally should do things? Is that helpful, unhelpful? I'd love your thoughts on that.
So I think we need to sort of reflect on one of the great things about the English legal system and trusteeship is the ability to do lots of different things. We don't have sort of a European model or a model which most European countries have, where it's a code and you can do the following things. We very deliberately in our legal system have huge flexibility and this idea that people have the freedom to do what they want. And I actually think that's one of the reasons that we can be pretty innovative in this space, and there are innovative solutions which I don't think we should be ruling out. I think one of the troubles with the nature of trusteeship, and it goes back to this sort of lawyer doom-mongering place, is you're always going to be thinking around what is that sort of downside risk and what could happen. And I guess, can you look your members in the eyes and say, yeah, well, it didn't work out, but we looked at it and we thought about it and we honestly thought that this was the best place to go. I certainly wouldn't want huge amounts of sort of governmental intervention in this to say what you can and can't do. Whether there was be some industry guidance which was supporting trustees around what looks like sensible decision making, I think might be helpful. I think generally as well, I'm much more comfortable when trustees are responding to requests from sponsoring employers rather than off their own bat actively advocating for a particular solution. It feels fairly difficult to challenge a trustee who's decided that their sensible endgame is to make a plodding move along to a buy-in solution. That feels very difficult, I think, to say you would be able to legally challenge that. Provided, of course, that you'd done your due diligence and that you were comfortable with the financial security of the insurer and you understood the financial regime which sits around it. So if you want to move away from that model, I think it's much safer for trustees to be approached by a sponsoring employer that says, we've had this idea and we would like you to agree to it. And for all of these reasons, we think you can agree to it. And the trustee is then in a place of saying, well, this is the sponsoring employer's scheme. They established it. They've been responsible for funding it. We've worked hand in hand with them. They've paid off the deficit. And is it reasonable for us to then respond to those requests? From a trustee perspective, that feels a much safer place legally to sit than somebody that, over a couple of drinks decides to draw up their own plan around, oh, well, we could do this and we could do that. And that might just be me being sort of a cautious lawyer in all of that. But certainly if I was a trustee myself, I would feel much better protected if somebody didn't like the outcome, if it had been proposed to me rather than it being the sort of the child of my own brain.
Yeah, that's really interesting. That's really interesting. And I think, for me, there's, working in a big firm that kind of has a tax practice, there's some interesting analogies with how people think about tax. Often it isn't, let's innovate a structure or try and sort of do that. It's, let's work up 3 or 4 things, and then we'll ask the question, is this the right thing? Does this work? And it is much more that responding to proposals rather than, everyone sort of just trying to dream up things, as you say, over a few drambuis. I'm showing my age there. Charlotte, sorry, you were going to ask a question.
I was just going to say, surely a Campari and soda, Paul.
I love the fact that you drink drambuie.
Steady on now.
It's only my aunt drinks drambuie. But anyway, yes. What I was going to say, I was going to pick up on the flexibility, and I think we've touched quite a lot on geopolitical risk, I think, in this conversation. And one of the things that's really interesting, if we think about sort of geopolitical risk and sustainability, particularly apropos where we are with this Iranian crisis that's been sort of thrust upon us, in that managing those two things, like, for example, the re-emergence of geopolitical risk has meant that people have become much more interested in investing in the defence sector than they were. And there was lots of, no, we don't want to do that. That doesn't fit within an ESG framework, blah, blah, blah. And now it's come back on the agenda. And I think, obviously, the current crisis has pushed that further along. But then also we have this situation where if we really are in the position that Straits of Hormuz is closed and we can't get enough jet fuel or aluminium, sorry, I'm not going to say the American pronunciation, aluminium or fertilizer, is that going to then reinvigorate the sustainability investment agenda? Because then we're going to have to move very quickly to being in a green scenario if we can't resolve this situation. And I'm just wondering, how do we, continuing that theme of flexibility, how do we kind of flex with what is being thrown up by current geopolitical events and keeping that long-term investment perspective of, I don't want to be invested in the wrong things in 30, 40 years' time when my members retire? How do we maintain that within both a sort of trustee world and a legal framework? How do we keep this flexibility and break out of the behavioural trap of always fighting the last war?
Well, it's interesting, isn't it? Because you've used the words flexibility there. And when I think about sort of the shift in the defence spending piece, I just think about that as complete moral relativity, that, it's all very easy to be sniffy about defence investments. Well, until someone starts knocking on your door and it looks like you might be invaded, and then you start to take a very different perspective on this and go, oh, hang on, the defence industry is completely legitimate and now I need it. I'm supportive of it. I think the shift in ESG analysis has been really interesting to follow. And I remember when, at the outset of it, when it first started to be applied to pension schemes, thinking, oh, this is a great idea. Of course, pension schemes should be doing good. And then you start trying to pick away at like what does good mean in this context? And, the smug mother that's putting a sort of one of those very expensive fruit smoothies in their child's mouth compared to the fizzy drink in the bottle which the baby's drinking. And you're like, well, actually, the latter one has a much lower carbon footprint than the former one. So, who should really be smug about that? And that's what I mean about this point about moral relativity. I think trustees have to sort of try and take long-term views on all of this. I don't think that you can be driven by fads and campaigns. And actually, I question whether some of the fads and campaigns that we've had around things like defence spending, actually we should have been much more critical of initially and said, well, hang on, actually, do we think that this is a good financial investment? And actually, are we really convinced that this is an immoral investment? And you could make that the same around, I think, the gas and oil industry as well. Lots of pension schemes have been under real pressure from campaign groups about their investments. A lot of them have taken that really quite seriously. But fundamentally, what you're asking yourself is, am I investing for the long-term good of my fund? And yes, I might want to do some good as we go along in it, but actually that's really what my duty is. And I think that really mirrors the long-term nature of pension schemes, and it should also really mirror the long-term nature of trusteeship, because trusteeship is not something which you should decide one thing one week and something else the next week. If you are genuinely thinking about best interests, long-term financial interests, that should be your driver.
I think that's really fascinating, because I think there's you can do a lot of virtue signaling, right? You could build a perfect green portfolio today, but it won't. When you wake up tomorrow, the world will still be burning alive, right? So there is a sense of you've got to get your hands dirty and you've got to go brown to go green, I think, is one point. And then there is a whole separate and equally valid discussion to be had about how much of this is the responsibility of companies, of members, of trustees, of pension schemes, and how much are we just trying to fill in the gaps where policymakers haven't grasped the nettle and haven't forced everybody to be in a situation where they have to clean up and become greener and move it along. And I know we operate within a global context, so that also adds a whole other layer to it. Even if the UK was the greenest country in the world, what difference is that going to make? I mean, I think those are all really genuine conversations that we can have, and I don't think they often get aired enough about.
Yeah, I mean, it's a real bugbear of mine that the government basically makes a policy decision that it wants, ESG, it wants sustainability, and it puts a lot of pressure on pension schemes to basically deliver, but it doesn't give them a legal safe harbour. It doesn't fundamentally change the law and say, actually, if you invest in these things, we will not criticise you. You cannot be sued. Members can't take action against you for having invested in these products. We will give you a sign-off that that's fine. What they do is they put all of this sort of regulation and reporting requirements and very strongly shove you towards doing that, but don't actually give you the ability to do it in a risk-free way, which I think sort of puts trustees in a really difficult position.
Yeah, it does. No, it definitely does. It definitely does. It's always been a fascinating part of pensions, isn't it? The sort of crossover of, kind of because of investing and the moral outcome of so many things. It's always been an interesting space for that reason. I wonder if we can maybe move to our final question, which is a question, Claire, we ask all of our guests on our podcast. And that is, if you had a magic wand, based on your experience in pensions across your career, what would you change? What would be the one thing you would change, or perhaps for the future, looking forward to make it so if we're doing this again in 5 years' time, we're all feeling more positive, what would be the thing you would change?
Well, I think first of all, if I had a magic wand, I'm going to do some stuff in my private life before I tackle pensions. But if you're going to make me tackle the pensions question, I think my sort of quick and glib answer would be I want to blow up GMP equalisation. Nothing, in my opinion, has been a bigger waste of time, money and effort. Only the likes of you and I have basically managed to gain anything from it in the basis of fees. And at its best, I think it's very fringe to the issue of equality in our society and in pensions. If you look at like the pensions gender gap, the pensions race gap, I'm just like, this is just like messing around the edges of it. I think the wider answer is that pensions are incredibly important. They are societally really essential. They underpin a big chunk of our economy and they make a huge difference to the day-to-day lives of people. And we become hamstrung by the technical detail and the process and the inability to make a sort of a general position on something and worry about whether we've underpaid or overpaid by 4p or 5p. I think GMP equalisation is probably the most egregious example that I've seen of that, but others exist. I think the Virgin Media case was another example of a complete waste of time and money. Thank goodness the government did something to sort that one out. I guess the other solution would just be to stop pensions litigators ever being able to bring any cases, but I fear that I might be on the striking end of some fairly harsh comments from colleagues if I put that one forward.
No, well, and having worked with some of your excellent litigation colleagues, likewise. So, well, no, thank you. Well, and it's interesting. Maybe we shouldn't have called this reimagining pensions. We should have called it "How Bad Is GMP Equalisation?" Because I think on every single episode so far, it hasn't come out of it particularly well. But
did you want to keep the listenership to 5 people?
it wouldn't have been quite as good branding. I'm certain. So. Look, thank you so much. Let me bring it to a close there. Firstly, Claire, thank you. Really, really interesting insight. Really appreciate your time. So thank you for sharing with us. I hope you find your magic wand for both pensions and personal life. Maybe we'll do that on a different podcast somewhere else. That sounds like a lot of fun. As always, Charlotte, thank you for bringing some professionalization at least to our journey of podcasting. So thank you, appreciate it. Listeners, thank you very much for joining us. Please do subscribe to the Reimagining Pensions podcast series so you don't miss any further episodes. And thank you for joining us. It just leaves me to wish you all a good day. Thank you.